In today's episode of Joe Knows Retirement, we're going to be talking about end of the year tax planning. This is something that we've been extremely busy with at our firm, planning for our clients to make sure that they can get everything done before that December 31st deadline, to make sure that we can get all the tax planning done so that when it comes time to tax prep and get all of that organized and situated for the IRS, that we've got everything done that we're wanting to get done to make sure they're in the best spot possible. But the best news is saving the most money in taxes that they can over their retirement, especially for this year. So in today's episode of Joe Knows Retirement, we're going to be talking about strategies for end of the year tax planning and things that you definitely want to make sure you're aware of as you do this planning yourself.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So I'm the author of a book called I Hate Taxes, and yes, I do hate taxes, by the way. I want to make that very clear. I don't mind paying my fair share, but I don't want to pay more and tip Uncle Sam if I don't have to. And so if I can implement the right tax planning strategies to put that in place, then that's what I'm going to do. And so in that book, we talk about a lot of these types of strategies we're going to be talking about here today, of these end-of-year tax planning strategies to make sure that we're in a better situation moving forward. And I really wrote this book for those who are in or near retirement, who have been diligent savers, who really want to get ahead of these tax planning strategies to make sure that they're not paying more throughout their retirement. And so a lot of these obviously have to get done before December 31st, which we'll talk about here today. So, we've been talking for a few years now why it's so important to do tax planning each year moving forward right now. And the reason why is because we have the current Tax Cuts and Jobs Act in place. So in 2017, President Trump enacted this, and this is good to go until 2026. And that's when it's set to sunset. So basically taxes have been lowered for most people about 20% during this period of time. And so because of that, 2026, we could see higher tax rates. Now, as we all know, Republican president just got elected, Republican Congress, looks like a Republican House at the time of this filming. And so if that's the case, there could be an extension of the Tax Cuts and Jobs Act. Nothing is promised, that still has to get passed, but that's where a lot of experts consider, hey, that could be realistic. If so, great news for you, that even opens up more room to do some tax planning at these lower, more efficient rates that we're seeing here today. And so if you're hopeful for paying less taxes in retirement, that's what you're hopeful is going to extend. And so that's just something you want to have on your radar. But that doesn't take away from any of the importance of doing tax planning this year, because it's probably not going to be lower than this moving forward, is what I personally think. I think that right now our tax rates are among historically lows. They could go lower. Tax codes written in pencil, as I talk about in my book, but historically they've been much higher. And so because of that, we need to make sure we're really maximizing this year and getting these things done. So one of my favorite tax planning strategies right now that I talk about quite a bit is a Roth conversion. And so this is something that many of our clients are taking advantage of before December 31st is the deadline for this. And again, this is simply where you just move money from an IRA to a Roth IRA. Now, obviously, it isn't that easy. We've got to pay the taxes if we want to make that transition. And so we have to do the math to see, does that make sense to do? So this sounds very simple, but it is a lot more complex. But also understand a Roth conversion can be really pivotal for a tax plan because it impacts so many different things around tax planning. It affects your future required minimum distribution, right? That's the amount that you're forced to take out at 73 or 75. And the more you have in tax deferred, the more you're going to have to be forced to take out. Whereas if you do Roth conversions now you're going to lower the amount in your tax deferred, raise the amount in your tax free, and now you're not going to have as much of a burden from your RMD in the future, which is going to allow you to pay less in taxes in the future is ultimately the idea. We also see that Roth conversions can help with Medicare premiums, right? If you're taking out from a Roth, that doesn't count towards your income to decide if your Medicare premiums are going to be at a higher cost or not. And so that's something that starts to impact people at 63 and on when it comes time to get Part B Medicare at 65. It looks back 2 years to 63. And then every single year ongoing, that's something you're going to have to pay attention to how that works. And then it also can allow you to avoid other eventual tax concerns such as, AMT or net investment income tax or certain credits deductions that you could phase in and out of. And so again, it just gives you more flexibility that when you go and take out money from your retirement, right? If you're looking to do some income planning as well, now you have the flexibility to either take out from tax-free or tax deferred, and now you have the control to ensure that you are staying in the lower brackets, to make sure you are under that Medicare tier, to make sure you can't have some of your Social Security be less taxable or potentially tax-free. And so again, just getting ahead of these things is going to be important. And a Roth conversion is a big point of why we want to do that. And so again, when we do these Roth conversions for our clients, we're not just looking at this year and that's it. We're doing a projection out in the future, and we have specific tools, reports, software that we do, and we typically spend at least 20 hours just on this Roth conversion analysis because there's so many moving parts to it. And basically what we're looking at is if we do a Roth conversion today, one consideration is we have to make sure we're paying that tax at a lower rate today than we expect to in the future. And so that's one thing, but we have to understand what is our future tax rate going to be, especially knowing that we don't know what future tax rates are going to look like. And so we have to use some projections to understand what is our future income going to be through RMDs, through maybe a pension, through what do we expect Social Security, when do we expect to take it. And so all of those are going to help that conversation. And so we have to run the reports though to see, like, if we do a $100,000 Roth conversion a day, is that going to increase our net worth over time or is it not? Is this going to allow us to save more in taxes over time, or is it not? And so should we do 100,000 or should we do 200 or should we do 50,000, right? And so those are what you're doing in making this decision. So we get a lot of people who come to us who say, hey, look, I've been just guessing on how much to convert. I'm not finding the optimal amount, and it's time to start making sure I don't make mistakes here. And so if that's you, make sure you get the right type of help. Again, you can try to DIY this. I hope these videos can be helpful for you as you look to do so, but I would encourage it. It's extremely hard to do if you don't have the right software in place with all these moving parts that we're talking about. But the Roth conversion is a very important one to do. If you have $1 million or more, that's when Roth conversions start to become more advantageous, in my opinion. If you have $1 million or less, it can still make sense, but now you may not have as much of a tax burden moving forward. And we really see those who have about maybe 400, 300,000 or less. Roth conversions may not be as advantageous, but anything more than that, it's going to start to make sense to do it, is what we're typically seeing. So just a rule of thumb, and just something to consider there. So something else on top of a Roth conversion, if you really like that Roth idea that you can do before the end of the year for some tax planning strategy, is to fund your Roth 401ks if you're still working, or maybe your Roth TSP or your Roth 403b or whatever options you have there, or maybe you fund your traditional accounts, right? And we'll talk about the advantages of each of those. And so as we know, you can maximize your retirement accounts up to $23,000 for 2024. And if you're over age 50, which most people watching this channel are, then you can actually contribute another $7,500 to your 401k. And that can either go to Roth or it can go to traditional. And so you get to decide where you're going to make sure you put that money. And so should you do Roth or traditional there? Well, it's obviously going to depend on your situation. But if you already have a lot in tax deferred, again, to my point earlier, maybe it makes sense to diversify and start to have more of a balance in your Roth. So this is an opportunity for you to really start funneling money away if you have the extra cash to do so. And we typically see this advantageous if you have a lot of either cash or maybe non-retirement accounts where you can now reposition that money, which is typically taxed as ordinary income on the growth or capital gains. Now you can reposition that money into a Roth, which grows tax-free. And this can also go back to the concept with the Roth conversions is, if you are going to do Roth conversions, maybe you'll pay the tax out of your non-retirement accounts or your bank accounts, again, to remove that future tax appreciation that you may have to pay, to have that be more in the Roth of your conversion. So if you convert $100,000, you have a $25,000 tax bill. Well, now instead of withholding from the investment and only getting $75,000 over to the Roth, now you can have $100,000 go to the Roth and pay the tax over here. So now it's more in the Roth, which is ultimately the goal there. But just be aware of that if you are 59 and a half or younger, that you may have to pay a penalty if you withhold out of the investments. And so there also are some other strategies there that you can do, but certainly having the bank account, the money in non-retirement accounts that you can access without a penalty could be advantageous for you there as well. But having this opportunity with these Roth 401ks or traditional 401ks to contribute up to $30,500 if you're over age 50, I mean, that can be a significant amount that you can keep stocking away. And if you're planning on working a few more years, this is something you definitely want to make sure you're taking advantage of if you have the ability to do so, to start building up that leverage there, especially in the Roth, and that's going to be good for you. So we see a lot of our clients doing that and trying to funnel that away at that point in their lives. Some other end-of-the-year tax planning strategies that we're looking at are regarding charitable contributions. And so definitely some different ways to do this. A lot of people right now are taking the standard deduction. 90% of people take the standard deduction. Well, if you plan the right way, maybe we itemize 1 year and then take the standard deduction the rest. And that's what we're going to talk about here is what's called a donor advised fund, or maybe bunching charitable deductions could be another way to do this. But a donor advised fund is something I personally do myself. It's something I'm in big favor of. This is the ability where you can basically do all of your charitable gifting in 1 year, but not give it to the charity all in 1 year, right? We may not want to just give money to a charity. Let's say it's $100,000. We may not want to give $100,000 to charity in 1 year. Maybe we want to give $10,000 over 10 years. So this is a way that you can put $100,000 into a donor advised fund. You get the tax write-off this year to be able to itemize. And then every year ongoing, you can just take out from this fund and give it to the charities. And you get to decide if you want it to be $5,000 or $15,000. You get the decision of what you want that to look like. And so this can be advantageous because if you just give $10,000 a year every year, well, the standard deduction is almost $30,000. You may never get over that limit and never get any additional tax benefit. Whereas if you give $100,000 this year, and let's say you technically give nothing to charities over the next 10 years because you gave it all in this year, well, you're still going to take the standard deduction. So you're in the same spot. The difference is you got this advantage all in 1 year. Well, now we can offset that with maybe a Roth conversion that we talked about, or maybe some other tax planning strategy that we can do to make sure that we can utilize the lower taxes with that write-off that we're going to have. And so this is why the donor advised fund is very important. So you'll have to do this by the end of the year if you want to maximize for this year. If you haven't done it yet or you haven't had the time to plan for this, no problem. Just push this off to next year, and this is something you can do next year or any year at that. But the key is you want to look to give as much as you can in charitable gifting in 1 year to be planning for the future. And this is really advantageous if you can do so for the future, right? So, if you're only going to do this to give for this year and next year, it could still be advantageous. But again, you've got to get over that standard deduction is where this really starts to come in handy for you. So that's just something you want to make sure you're aware of. And with this donor advised fund, we typically advise to do this until you're about age 70 and a half. And you're probably wondering, why 70 and a half? That's a weird number. And I'll explain why. So if you're 60 years old, again, maybe you give 10 and a half years of charitable gifting that you plan to give over the next 10 and a half and all in 1 year. And again, you have to have the ability to do so. You have to have either the cash on the sidelines to be able to put that amount into this, or what is my favorite to do is take a highly appreciated asset. Maybe you have a stock in Amazon that you've owned for a while and it's grown quite a bit. That is a great one to move into the donor advised fund and then sell it off when it is in the donor advised fund. Not only do you get to take the itemized deduction advantage, but also you get to write off those capital gains and not have to pay any taxes. So, typically if you sell off that Amazon stock, you have to pay 15% for most people in capital gains. If you sell it off in the donor advised fund, it's no capital gains. So you get the capital gains advantage and you get the itemized deduction advantage. That can lead to a lot of money in tax savings over time just through those advantageous ways. And again, you don't have to necessarily have the cash to do that. You just have to have the asset to be able to transfer that. So if you have that in a non-retirement account that's taxable as capital gains, that's something that I do every year. Not every year, I try to plan it ahead, but when I have big gains in my investments, I move them over to my donor advised fund, write them off, and I get to itemize that year, which is very advantageous. So, but the reason why you want to do all this until you're 70 and a half, so again, if you're 65, maybe you only do it for 5.5 years, is because once you're 70 and a half, again, most people watching these videos have a lot in tax-deferred vehicles. They can then do something called a qualified charitable distribution. And if you are 70 and a half or older watching this video right now, this is something that you can do before the end of the year as well as another tax planning strategy. We know that most people watching these videos are 55 to 70, but if someone's watching a little older, then just know that you can do this before the end of the year. And again, you give your money from your IRA to the charity tax-free. Can be a great way to do charitable planning. We see that as very beneficial with the people having a lot of money and tax deferred at that point. So basically donor advised until that point, and then QCD after that point is typically what we're implementing with the clients we work with. Another tax planning strategy, which I'll call more of a reminder but can be strategy in itself after I explain it, is if you have any inherited IRAs, make sure you take that amount this year before the end of the year so you don't get penalized. Depending on which type you have, you may have a stretch IRA, which means that this is something you have to take out a smaller amount over your lifetime, or maybe it's a 10-year IRA, inherited IRA, where you have to take that out in 10 years. And so something we've been looking at with our clients who have an inherited IRAs in this scenario is maybe look to, if you are going to do a Roth conversion as well, maybe look to withhold your taxes from the inherited IRA. Remember how I talked about withholding it from the non-qualified retirement accounts? Well, now you can do it with the inherited IRA. So let's say you're maybe required to take out $20,000 and your tax bill is $20,000. Just send 100% of that to the IRA, or sorry, not the IRA, to the IRS, and that will satisfy your tax burden, and then you can convert more over to the Roth. So that's one way. Or if you're going to need anything for any specific home improvements or income for anything, take it out of your inherited IRA and maybe maybe you take out more than what you're expected to, and that way you can start to dwindle this down during the lower tax rate environment. So almost consider this as part of the Roth conversion strategy, right? If we have $150,000 of room before we hit Medicare premium tiers, before tax brackets go up, well, maybe we can take out $50,000 from the inherited IRA, and then we'll convert the $100,000 on the other side. But typically, we want to look to try to dwindle these accounts down now while tax rates are lower, versus waiting for these over time when tax rates could be higher and be forced to take out of them at future times. So just a consideration, some strategies behind if you do have those inherited IRAs, because there's typically no penalty to take out from those early, even if you're under 59.5 there. Another tax planning strategy for the end of the year is capital gains management. So again, we just kind of talked about with the donor advised fund. I talked about how I personally do it. If I have appreciated stocks, and I'm going to take that and I'm going to move it to my donor advised fund, and I'm going to do so before the end of the year so I can take advantage of that growth in that account, but also be able to utilize it for this year's tax return. And so that's the key there. And the other thing I'm looking at for my personal stuff and the clients we work with is, hey, is there any losers there that I should sell off to be able to offset and write off? Or, are there any gainers there I want to move to the donor advised fund? Or maybe I want to sell it off because I have some capital losses that I can offset. Or maybe, now's a good year for me to utilize the 0% capital gains bracket, which is pretty generous. If you're not aware of that, that's going to be a very important planning opportunity there for you. If you are, in retirement or you have a lower income at some point, utilizing that 0% capital gains bracket is something you want to look to do every single year. But again, you have to do it before December 31st. And so that's why it's so advantageous to look at before year end. Then also with capital gains management, be aware if you have any mutual funds in your portfolio. We typically don't advise mutual funds because of what's called phantom gains. But if you've had high amounts in mutual funds and they've been paying capital gains and dividends throughout the years for making trades in those accounts, you need to understand what that amount's going to do as you make these decisions on all the other strategies that we mentioned today, because that could raise your income unexpectedly because you won't get that reported to you until after the end of the year. And so, you can do some calculations, get a feel of that to make sure that you're not putting yourself over Medicare tiers or in higher brackets because of that when making your other decisions. And then one of the other strategies that I want to make sure I make very clear is not necessarily an end of the year strategy, but this is going to help all these end of the year strategies that I've just mentioned. And this is when it comes to funding a Roth IRA or funding a traditional IRA. And notice I'm going to emphasize a traditional IRA quite a bit here because it could be advantageous for you to do a traditional IRA at this point. So with these IRAs, you have until April 15th to do this. So I love this concept because we can go back in time and fix anything that we can up to a certain amount. So for example, for an IRA, you can contribute $7,000, and then if you're over age 50, there's a $1,000 catch up, so you could do $8,000 total. So that's per spouse. So if you're married, you have $16,000, and I like to call this kind of a buffer, right? Because if maybe we went over with a Roth conversion, $16,000 that we now are in a Medicare tier, well, maybe now if we have earned income is the key, we have to have earned income of some sort. So if you work part-time or full-time, this can be an opportunity. Well, now we can potentially lower our income below that tier just by doing an IRA. So, by April 15th, we're now having a better, clearer picture of what our tax preparation looks like so that we can get really particular to be right where we want to be and save, if it's a Medicare scenario, maybe thousands of dollars on that decision by being able to decide if we want to do Roth or traditional. So we typically like to wait on that if it's going to be close. If not, then just get it done right now to get the advantages moving forward, the tax advantages there. And then you have to decide again, traditional versus Roth. So, for example, we've done a traditional IRA for someone where we thought for sure we were going to do a Roth, but they were just over the Social Security tax torpedo where they started to force Social Security to be fully taxable. And so we were able to do the IRA and back them down and save them almost a 40% total tax rate because they not only saved on federal taxes, but also they didn't have to pay as much tax on their Social Security. And so all of that technically saved them $40,000 on that $7,000 that we took out. So, they saved almost $3,000 in taxes in that year. And so that's some of the advantages that you can look at by planning that type of way. And so the key here is to make sure you're working with an advisor who is filing your taxes and doing the tax planning. So there's everything's collaborative and everything's done all together. So you don't miss any deadlines. And so you don't miss any strategies or you don't, anything that was done, it gets implemented. Because we've seen before we had the CPA in-house where, working with other CPAs, they just may not be as diligent or intentional. They may be filing 1,000 returns that year, and they're just pushing paper. They're not really thinking about strategically of how can we maximize this. And so that's why we personally have, estate planning here as well as tax prep here, and as long as our 5 pillars of financial planning. So we just have everything collaborative, so we don't have to go to 100 different places. Everything can be done right here to ensure we've got everything done the right way. So if you're looking for help with some of these end-of-year tax planning strategies, and this is the type of planning you're looking for, feel free to schedule a 15-minute call with us. You can do so in the description below. And you can have a time with our team here to see how we can help you and see if we could be a good fit to serve you here. If so, we'll set up another session to explore further and look to make that decision to get moving on some of this planning for you to make sure you're in the right position. So I always want to preface that with, we have a lot of people that do reach out to us, so we'll try to make sure we can take that call. That's always our goal. And then if there's, if it makes sense for us to work together, we can explore further. If not, we'll shake hands and make sure that you're set up for success is ultimately our goal there. So regardless of that, that's all we've got on today's episode of Joe Knows Retirement. Happy planning for end of the year.